Hello, everybody. If you are hoping to hear about taxes today, you are in the right place. We are going to spend the next hour talking about taxes in retirement, which is what you signed up for, and I'd like to commend you greatly for taking an hour of your day to learn about something that is very important. As you, some of you are either pre-retirement or getting ready to retire. It's a really, really important part of what you're doing, and so I commend you for being here. So just a couple things. As I mentioned, we'll be done with this in an hour, so we'll spend an hour together, and there isn't a place for you to enter questions as we go through this. If you have questions today, feel free to type them in, and we'll try and reply at the end of our of the scheduled slides. We'll try to get to the questions. If we don't have a chance to do that, we can follow up afterwards to do that. And we also, one other thing, during the presentation today, we do have 3 polls that we're going to ask you guys to participate in. So please listen up for that, and it's just a quick click on the screen, okay? So 4 stages of retirement planning. First of all, I just want to introduce myself. My name is Julie Hupp, and I am a speaker for taxes and retirement. I also have a business called Aspire Planning Group, and Aspire Planning Group is a financial planning and investment firm locally here in Grays Lake. My background educationally is I have an accounting major from U of I, so I'm local. I also have a finance degree, a master's from Kellogg Graduate School. I got my CPA when I started working initially, and I also have a CFP. So while I don't prepare taxes, I certainly stay on top of them quite a bit because it's important as we do planning for people. And a little fun thing about myself is I did complete an Ironman triathlon. I don't do that too much. I think I'm a one and done person, but I do like to get out and stay healthy. And as you can see from the picture, I have a husband and 3 children and a dog named Bear. Actually, in the picture, you see 2 of my children. A personal story, a little bit sad, is you might remember the time period of 08 and 09. It was the Great Recession, and for any of you who, I'm guessing around this, you're all close to retirement age, so you definitely experienced that tumultuous time. And I started in the business in 06, so it was fairly new as the market started going crazy. And in November of 08, my husband lost his job. And in January of 09, my oldest son got sick and was diagnosed with cancer. So it was very, very hard time for us, as you can imagine. And we went through 09 with all the market upheaval. And unfortunately, we did lose our son. He wasn't able to beat it. And my husband didn't get a job until February of 2010. And I share this because during that period of time, I always consistently said, thankfully, one of the things we don't have to worry about as much was finances. We certainly had to worry about them, but we'd done a lot of work to do cash reserves and things like that. And so I always felt like I would hate for someone else to be in this situation with all of these problems and also really, really being worried about their finances. So that's kind of why I do some of this public education, and now we're doing webinars as opposed to in person, but I really do love the education piece of it. So that's what I'm here for today, is really to educate you on taxes. We're not selling you, we're really educating you. So I commend you again for taking time out of your day to learn more about taxes in retirement. But before we get into the details, the question is, why are you here? So we need to get some answers, and we need to learn the truth about taxes in retirement. But are you ready? Hold on. Okay, we have a poll that came up. It wasn't the right time to do the poll, but we're going to have you answer this right now. So we're learning on some of these. So if you guys can just answer me, I'll get a sense of where you guys are in this poll question. Are you already retired? Are you within 5 years of retirement, or are you more than 5 years away from retirement? So if you could answer that, that would be great. We'll give you just a second. Okay, so, okay, that's good. We have a very nice mix. So most of you are retired or within 5 years of retirement. So it's a perfect time really to be learning about this. So that's wonderful. Okay, so we're here to get answers and truth about taxes and retirement. And are you ready?
You want answers? I think I'm entitled. You want answers? I want the truth. You can't handle the truth.
So that's always a fun snippet. I'm sure most of you have seen that movie, but it is true, because we can't always handle the truth as we get ready for retirement or we're in it, and all of a sudden we realize there's all these things we don't know. So we're going to kind of help you learn these things that you don't know so you can create a better situation for yourself. So for the past 46 years, most financial advisors, tax professionals have really been telling people that when you retire, your taxes will likely go down for a variety of reasons. You'll have less income, you know, not likely more deductions, but tax rates have also keep going down. So the messaging has always been your taxes will go down. And because of that, we created tax-deferred retirement savings plans, because if we could save money when taxes are high and taxes are going to go down, it's better off. We're better to take the money out when the taxes are lower as we get older. So that had actually worked out really well. So as you guys all know, tax deferred plans are you put the money in, you get a deduction from your taxes when you put it in, and then it grows and you get taxed when it comes out. So these are plans like IRAs, 401ks, names you've heard of, right? So all of these are these tax-deferred savings plans. And it really was a great concept, and it allowed us all to save a lot more. It inspired us to, you know, everybody likes to pay less taxes. So it allowed us to not pay taxes when you put the money in, it let it grow, and then you pay it when you take it out. And it grew a lot. So Americans' retirement plan assets have grown a ton. So from 1974 to 1920, they have gone up, and they're now at about $30 trillion. So that is a lot of money that is not taxed. But today, things have changed a lot, okay? So where are we today? So individual tax rates are cut. You may remember the Tax Reform Act of 2017, right? So for most of us, all of our tax brackets are a lot lower. So if you might have been in the 25% tax bracket, you went down to 22, 28 to 24. Now I know most of you are saying, yes, but my deductions changed too. They did, but from what we see when we, you know, review tax returns, most people actually have them paying a little bit less over the last couple years. However, these rates are only lowered until 2025. Corporate rates were cut a lot also. The flat rate went from 35 to 21%, which is really a huge change. And those changes are permanent. However, and I'm going to say this, and this is not political, but our US budget deficit has doubled in the past 3 years. And our federal debt is now almost 80% of GDP. It's projected to grow even more by 2049, and it really is higher than at any time in our history. And if those tax cuts are extended to 2025, the debt could go up to 219% of GDP. So to put that in perspective, if you make $100,000, that would be like having credit card debt of $219,000. So it's a very significant amount of money, because I don't think any of us would want credit card debt of $219,000. And that was before the situation we're in now, which is the coronavirus aid package. Most of us think that it was helpful, right? It helped businesses, but that's going to add a lot more debt also. So what does all of this mean? It means that the government needs money, and we're sitting on it. So for the first time in 46 years, it's very possible that the taxes in retirement are going to go up. Okay, so that's what we're here to talk about today, really, and why you're going to learn about some things that can help you manage your taxes, as well as know about some of the pitfalls that you really should be aware of. So the other thing is, even if we don't see a direct bracket increase, you know, remember that there's other things that increase your costs, which could be fees. So on Medicare, Medicaid, we could see higher taxes on Social Security, lower thresholds for that taxation. We may get reduced benefits, right? They've been talking about, do you just get 70% of Social Security at some point? So these are all not exactly called taxes, but essentially they are. Another big thing is changes in inheritance rules. And that has already happened because the Secure Act, and the Secure Act, we'll talk more about that, but the Secure Act that was passed in last year at the end of 2019, what that did was the money that you have in those tax deferred accounts, your IRAs, you used to be able to pass those to your beneficiaries and they could take that money out over their lifetime. The big change is now they have to take that out over 10 years. So if you didn't know that, it's something really, really important, and it really creates a new need for some good planning related to your taxes. And we'll touch a little bit more on that in the future, or later in the presentation. So the point is, we need to plan ahead, which is why you're here. So thank you for coming, and I hope you learned something. So we're going to start off today with a little brain teaser. We're going to talk about a gentleman named Bill, and his income is, his taxable income is about $42,000. He has some IRA money and Social Security benefits. And that taxable income, as you can kind of see from the right, puts him in the 22% tax bracket. So he wants to go on a road trip. He wants to go see a concert, which is not something most of us are able to do right now, but maybe next year he's going to do it. And so he wants to take another $1,000 out of his IRA to do that. So I ask you, if that is the case, how much do you think he'll pay extra in taxes? So I'm going to let you just look at that for 1 second. Most of us would think that he's going to owe 22% because that's the tax bracket he's in. So that would be about $220, right? Wrong. He ends up owing $407 in tax, which is a 40.7% rate. So that is one of the traps we're going to talk about as we go through this presentation. But it just illustrates that it's not always so simple what tax bracket you're in to understand what the impact is of using some of your accounts. Disclosures are always important, and I caution you that I am not a tax preparer. So as you look to do any of these types of things, please seek out a professional CPA, tax preparer for doing any major thing, and know that I'm not a practicing tax professional. I also want to kind of clarify for those of you who don't know some terminology. So a traditional IRA is something that's called tax deferred. So you put the money in when you deposit it in the account, you get the money off of your taxes that year. You get the tax break the year of, and then when it grows, you pay taxes when you take it out. A Roth IRA, on the other hand, is when you put the money in, you do pay taxes on it, but it can grow tax-free until you use it, and then it's still tax-free. And we're not focusing too much on state taxes today, but all of these, you still have state tax issues also. So what are we going to cover today? So our agenda today, and I mentioned we're going to definitely keep this within 1 hour, but we're going to talk about 4 key things to think about. So things to be aware of before you retire, which is good we have a lot of you on the call. We're going to talk then about some Social Security and Medicare traps that you really need to be aware of. Key 3 is we're going to talk about distribution strategies. So once you start using your money, what are things to be aware of? And then key 4 is as you think about passing your wealth and estate planning, how do taxes impact that, and what should you be thinking about then? We'll have a section timing for some questions. As I mentioned, you can enter questions in that question box, and discuss a strategy session if you'd like to get some more information after this presentation. So we talked about the 4 keys, and the 4 keys are really going to relate to kind of 4 stages of retirement. So you know, many of us think about as we enter retirement, you've got pre-retirement, which, you know, the ages change, right? It may not just be ages 50 to 60, but, you know, that's kind of it. It's some of your highest earning years. You're still working hard and doing all those, and, you know, really preparing to have yourself situated for retirement. Then early retirement, or what, you know, we might call the go-go years, ages 60 to 70. I always joke, a lot of our early retired clients, we can never get appointments with them because they're so busy all the time. So, you know, people traveling more, they're just doing, you know, doing all the things that they wanted to do more of when they were working. Then we have middle retirement, you know, somewhere between 70 and 80, a little bit slower for some people, not everybody, thankfully, and then late retirement. And so the keys that we're going to talk about kind of relate to these periods of time. And what happens is, as you move from, say, your working years, where you're really thinking mainly about just working and saving, you move into retirement where it's a little bit more complex, because you have different sources of income, you have different taxes that income is taxed at. So it becomes a little bit more complex, especially because you're just learning too. So it ends up being a little more complex as you move from just work and save to now you got these sources of income and different taxes. So it's good to be aware of the differences. One of the problems that we see is people often end up paying a lot more in taxes than they thought. And it's mainly because of these hidden taxes and issues that people just aren't aware of. So what we want to help you do today is gain enough knowledge so that you're able to help create a solution for yourself to avoid these extra taxes and surcharges. Okay, we are going to put up our second poll question right now. So the question is, what is your major concern about retirement? Running out of money, investment loss, healthcare cost, or reduction in income? So go ahead and select what your bigger concerns are. I think we'll have the answer here in a second. Running out of money, 16%, investment loss, healthcare costs, reduction in income. So that's great. And I can imagine many of you, the investment loss is probably, you know, we're just coming out of this whole COVID scare, and many of us just went through, you know, a tremendous loss in our portfolio. So no surprise that is really right now ranking high up there. Had we done this a year or two ago, that I'm going to guess that wouldn't be as big of a concern. But there are a lot of retirement surprises. I would say that volatility in the market is a huge one, and definitely one you should be concerned about. But there's some other ones too that people don't always think about. Inflation is a very important one. You know, we've been very fortunate that inflation over the last 10 years and so has been very low. But for many of you, you know, who remember the 80s, we had very high inflation. You know, interest rates, mortgage rates, everything were much higher. And if that is the case again, right, that makes things more challenging for all of us in retirement. Longevity is a big surprise. People in their heads really don't think they're going to live as long as they do. And so sometimes, you know, people aren't planning for living as long as they end up living, which increases expenses, and healthcare too. You know, we're not always really aware of how much healthcare impacts your expenses. So these are just surprises that are out there, along with the tax issues. So what's the first thing you need to know about retirement and taxes? Key one, before you retire, be very aware of kind of what you're going to have in your after-tax retirement savings. So what I mean by that is, we have different accounts. So you may have a bank account, you may have your IRA or 401k, and you may have a Roth. Each of those really represent a different amount of money, because if you have a $500,000 401k or IRA, depending on your tax bracket, that money is a lot less than you really have. So, it used to be back in the day, probably, I don't know, years ago, the question always was, well, I need $1 million to retire. Or people always will ask me, well, how much money do I need to retire? And my answer to them is, well, it really depends on a lot of things, but what you need is also based on the kind of accounts you have. So a Roth account with $500,000 in it is worth way more than an IRA with $500,000 in it. And a bank account with $500,000 is kind of like a Roth, because it's not going to be taxed. So before you retire, think about kind of what your after-tax value is going to be. And so if you can keep your tax rate lower during retirement, you end up with more money. And that's kind of the whole point of what we're trying to illustrate today, is that we want to try and manage taxes through the whole retirement period. So it's not just that you pay a low amount in years 1 and 2, you pay a lower amount over the span of your retirement. So this just illustrates, it's kind of simple math. If you had that $500,000 and it grew over time, what you would have if you had different tax rates. So, I mean, no one's really going to have a 0 tax rate. That's unusual. But, if you had a 12% versus a 33%, you can see the difference in, your overall cumulative amount of money that you would have, and it makes a big difference. So it's important to really manage your tax rates. So we know we may have a little bit less because of how our retirements are structured, but most people are thinking, well, I have Social Security, which will help, so I have some income sources. Maybe you have a pension, and Medicare is now going to help with some of my health costs. And that's true, but we want to be aware of how the taxes reduce those also. So key 2 is we just want to be aware of the traps with Social Security and Medicare, and let's plan for these too. So here is a little illustration. This goes back to Bill's tax rate that we talked about of 40.7%. So the only difference really he had in income was that $1,000 in his IRA income. However, when we talk about taxable income, what happened was his taxable income went up to $1,850. And the reason for this is how Social Security is taxed. So Social Security, you can either have no Social Security taxed, 50% of your Social Security taxed, or 85% of your Social Security taxed. And it all depends on what income tax bracket you're in. So if you add income into a tax bracket that moves you now to having to include 85% of some Social Security income, then that immediately raises your tax bill a lot. So you want to be very aware when you're taking money out and paying attention to what brackets you're in for Social Security. And the brackets aren't really high, but you still just need to be aware of what those are. So it'll move you into higher tax brackets for sure. So also thinking about Social Security, people have different kind of goals in retirement. So some may want to retire completely. Some want to just work a few hours, still stay in their job. People want to move to passion-driven jobs. There's all kinds of reasons people stop working and kind of what they do after they've officially retire and how they make money. So one of the things to understand is a little bit, how is Social Security calculated? So the way they calculate Social Security, your benefit, is they look at your 35 highest earning years. So if you many women who are out there, and I know we have a fair amount of women registered, it could be that there were many years that you maybe didn't work. Maybe you were home with the kids or whatever that was. So if you have 10 years that you had no income, that's treated as a zero. So your calculation includes those 0 years also, which is why a lot of women's Social Security ends up being lower. However, the good thing is that if you do keep working, you know, after you officially retire, every year you make a little bit more money, that replaces a zero. So it is really good to keep working, and really it's you don't have to make tons of money, you don't have to make up to the limit to really start to improve that calculation number. So the good thing is if you don't have 35 years, part-time work can be a real plus to add to your Social Security benefit. Now, a little bit of the bad. So this is if you retire and you start Social Security early. So early as anything, full retirement age is, for many of you on the call, it's somewhere between 66 and 67, let's just say. So if you started before that full retirement age and you continue to work, what happens is you lose your Social Security benefit if you make over $18,000. So $1 of benefits is withheld for every $2 earned, okay? Now, it's not like you lose that forever. It gets added back in when you stop working and at full retirement age. But just if you're trying to think about your income, you're gonna lose some of that Social Security income if you work. And you're not at full retirement age. So that's a big thing to consider. And the other thing I just want you to think about too, and I know you probably know this, is, you know, taking your Social Security before full retirement age, you lose quite a bit of benefit. It's like 8% per year. So that's a really good return, you know, that it really does pay to wait to full retirement age if you can, for many, many reasons. And I'm going to talk about more of those reasons a little later in the presentation. So the only negative is if you keep working and you've already hit your 35 years, you know, just so you know, you keep paying into the system even though you may not get any additional benefits, but that's just part of the system. So Medicare, what do you need to be aware of for Medicare? So there's something, as most of, well, if you're not retired yet, you probably aren't aware of this. So Medicare, you get access to at age 65, and but you do pay a premium for Medicare. And I'm going to skip this example. So we'll go right here to the Medicare premiums. So your Medicare premiums are based on your taxable income. So for a single person under 87,000 or a couple under 174, your premium amount is 144. But that premium amount keeps changing for different income brackets. So you could get a big penalty if you move from one income bracket to the next. So here's an example. We have some teachers with teacher pensions, which are, you know, are good pensions. And, you know, let's say they want to take out money from their IRA for a car, a decent car. So they're already maybe at 86,000, and they take out, $40,000 from their IRA. That could move them into this tax bracket, which could change their premiums from 144 to 289. So that's almost doubling of those premiums, which really, it just lasts for a year if you go back to your original income tax bracket. But it's just something to be aware of as you plan your income levels each year, that Medicare changes, your premium will change based on your income. So just strategize sometimes on your income and your distribution so you don't get bumped into that higher bracket. And you also pay premiums on Part D. So hold on, I'm going to go back here. All right, so the other thing on Medicare to be aware of is you want to be, in most cases, applying for Medicare at age 65. even if you work and you have a good work plan. And the reason is that oftentimes once you're 60, and it depends on your company's plan, but oftentimes at 65, the Medicare plan becomes primary. But sometimes people are thinking, well, I have company insurance, I'm good. So my suggestion is that, you know, as you approach 65, always, and you're still working, you know, talk with the HR department to understand how the insurance mixes with Medicare. Because what happens is if you don't apply on time, there's a Medicare penalty on the premium, and that penalty lasts for life. So, you know, even if you just did 1 year late and you had, you know, for the couple, you have, you know, a penalty of $14 a month, which is, you know, for a whole year, it ends up being close to $350. Over time, that adds up, right? It's all these extra costs. So just be aware if you're getting close to Medicare age 65, that it's, you can apply, but not, you know, not necessarily be paying premiums if you have work that's primary. But it's something to pay good attention to. So what are some of the other tax traps that you need to be aware of? So key 3, and I think this is maybe one of the most important sections. But before we do this, we're going to put up our 3rd poll question. Question is, what age do you begin RMDs? And RMD stands for required minimum distributions. So these are distributions from your IRAs or 401ks that have to come out. Is it 62, 65, 70 and a half, or 72? You guys are smart. So 72 is the new age. It was 70 and a half. And we'll talk about that, but excellent. You guys are on the ball for sure. So this section really talks about distributing money out of your accounts. And it's really important to talk about how and when you use all of these different accounts and how they fit together, because again, they can help you manage your taxes over a long period of time. So here's an example we're going to talk about. Let's say Sam and Mary have different accounts. They have their traditional IRAs that they each have about $450,000 in. They have Roth IRAs. Remember, money comes out of Roth, tax-free, and they have a bank account. So historically, and if you work with a CPA, they might say, hey, let's use everything out of the, you know, joint bank account. So for Sam and Mary, they want to spend close to $100,000 a year. You know, that bank account would, they'd be able to use that for like 3 years, and their taxes would essentially be 0, which would be great because we all love low taxes. And, you know, then maybe use your IRAs and then maybe wait and use your Roth accounts later. So that would be pretty typical advice that you might get. However, thinking about it a little differently, you could use some of that taxable money first, but then if you have 0 taxes, you're also missing out on low tax bracket opportunities. So first of all, you're missing out on your standard deduction. So you now aren't having any income to take your standard deduction off of. So that's the first thing you're missing. And then now your first 2 tax brackets are also at 12%, 10% and 12%. So you're also missing out on some very low tax bracket opportunities if you try and use too much of your tax-free money first. So one idea could be that you convert your IRAs to Roth accounts in those low tax years. So here's a bit of an example. Before you use a conversion, you know, someone might have filled up but we call this filling up the bucket. So you're like filling up your tax brackets. So in the first scenario, this couple was, you know, they'd had enough income for their 10% bracket, the 12% tax bracket, but 22% tax bracket, they were still they hadn't filled it up. So with the Roth conversion, what you could consider is filling up this tax bracket before you move to the 24%. And one of the reasons this is really important is because what we see a lot is we have a lot of clients that, you know, if you've saved well, you may have enough money in your IRA accounts that at 72, so 72 was the correct answer. 72 is now when you have to take money out of your IRAs. That changed with the Secure Act that was passed in 2019. It used to be 70 and a half. Now it's 72. So that's good to know. One other note, if you did not know this year, you do not have to take any RMDs because of the CARES Act from coronavirus. So you don't have to take RMDs. However, so what we have seen is a lot of people who saved, who were good savers, they have so much money in their IRAs that when they hit 72, they now have to take out so much money that it may push them into these 32% tax brackets, for sure, often 24. So the thought process is, while you can, blend your accounts. So maybe you have some from a bank account, some from an IRA, maybe do some conversion. So you start to use some of that IRA money in lower tax brackets because you don't want to have to take so much money out in your high tax brackets. So again, some planning needs to happen to understand that, but I think some people are really, really surprised when they see how much money they're required to take out at 72. It's really something that you want to look at. Some other times that's helpful to do a Roth conversion is if you have a low income year. This year is great if we think about COVID as an example. If you're a business owner, and I talked with a couple people on the call who were business owners, if you have really low income, again, it's still a good year to fill up those low tax bracket buckets. So it may be a good opportunity to do some of those conversions. So always be thinking about, what is your current tax rate? What might it be in the future? And those rates I had just shown, there's a good chance that those rates may go up too. So working before you're retired, even early retirement, to strategize which accounts to use really help from a planning perspective. So what are some other accounts and ways to try and manage those tax brackets? A lot of you that I see often have cash value life insurance that you really have no plans for how you're going to use it. So you can maybe, say you have a vacation you want to take every year, maybe pull $5,000 out of the cash value policy tax-free. Start thinking about how you want to use those policies. That could help you have $5,000 of cash flow with no income tax. Another method is using lower capital gains rates. Some of you may be employees who worked at Abbott or AbbVie or Baxter, right? We've got a lot of those folks in the area, and many people had bought stock over time or had been awarded stock, and so you may have maybe bought it at $30, but now it's worth $90. So there's a lot of gain in there. What you can do is, if you use some of those low tax bracket years to sell that, your capital gains could potentially be 0 or 15%. Again, lower maybe than your ordinary income rate. So there's opportunities to use different assets at different times to manage those tax rates. Same thing is, when do you take money out of the IRAs and 401ks? How do you manage that? It's really, really important to understand what your tax bracket will be when you're forced to take money out versus some of those early years of retirement. Some other things to think about is charitable giving. So when you are, let me go here. So once you're required to take distributions out, what you can do is you can actually give money directly out of your IRA and not have it count as income. And this is called a qualified charitable distribution. So the Secure Act, it used to be you could do it as soon as required distributions were required at 70 and a half. you would think it's now 72, but it's still 70 and a half. And the reason that this is very helpful is, again, because for many people, they have more money to take out than they need. So if you give it directly to a charity, you get that benefit. And as many of you know, the changes that were made in 2017, it's common that you don't get your charitable deduction anymore because itemized deductions are so high. So if you gave $5,000, but it still doesn't put you over that, that standard deduction, still give, please, but it could be you don't get an additional benefit for it. So one way you can get some benefit is giving directly out of your required distribution. Another way to do it, and this is more in our early retirement people, is and it's just a suggestion in the last year or two, is you can kind of bunch charitable deductions in 1 year. So if you are, if you have a church or you have a cause and, maybe you're giving $5,000 or $10,000 a year to them, what you could do is donate a larger amount in 1 year, get a bigger deduction in 1 year, and if you give that into a donor advised fund, what you can do then is give to charities over the next several years. So it's a way to get your itemized deductions above standard deduction and be able to still get a benefit from your charitable giving. So that's kind of a little strategy we've started using with people too. One thing, yeah, so that's just an option that you can make too. So I'm not going to go through the example because it pretty much is what I just talked about. So we've talked about now during retirement managing your distribution so you can kind of manage a low tax rate over life. But what about when you go to pass assets on to your family? Is there anything that you can do to think about that? So key for is estate planning still matters. The gift tax level, estate level, has changed dramatically over the last several years, and it's very rare that somebody has enough money that they pay gift taxes. But regular income taxes are still a very big piece of this. So a couple things that to be aware of as you're planning your family distribution is, we talked about that account that had, let's just say, Abbott stock in it and had a lot of gain. If you pass to your heirs an account with capital gains in there, it passes to them at market value. So that's a great account to pass to your children that has all that gain. So if, say, there was $300,000 of gain in an account, nobody would ever end up paying taxes on that. So be very cautious if someone wants to start rebalancing some of your taxable accounts that have a lot of gain in them, because you could miss out on a really nice opportunity to pass that wealth in more of a tax-free status. So another really big thing that has changed, and this is, I think, one of the biggest things to be thinking about and why it's so important that you have a strategy for your retirement accounts. The Secure Act, because the government needs more money, the Secure Act passed last year says that if you have an IRA, it used to be you'd pass it to your beneficiary. So let's say you're 85, you have a child who's 55, you'd pass it to them and they can then take it out over their lifespan. So if they have to just take, 10, 15,000 a year, that doesn't really affect their taxes that much. The Secure Act says that money has to be taken out in 10 years. They can take it all out at the end of 10 years, they can take it all out over years, but they have to have it gone by 10 years. So as you can imagine, if someone has $1 million IRA and they pass it to their child, the taxes that child, especially if they're kind of in their peak earning years, easily that money could consistently be in the 35, 37% tax bracket. if taxes don't go up even more. So this is a reason why you want to start thinking about maybe not waiting to your required years to take that money, why you might want to start thinking about Roth conversions, because the Secure Act is going to really increase the family taxation significantly over time. So please really think about this as you think about your wealth over a long period of time, because it can really impact you. Another thing just to be aware of, I'm not going to focus on it too much, but long-term care costs are typically deductible. So, you know, how and which accounts you use to pay for long-term care. Some people have life insurance to cover with kind of a rider to pay long-term care. But if your beneficiaries are going to get that tax-free versus another account that maybe you can take out but get the similar tax deduction for it, you may want to think about if you have to pay for long-term care, which is the best account for your family to use that. I'm going to skip through those. So how are you ever going to manage all of this? It's a lot. So I just kind of want to summarize some things to remember. Pre-retirement, be very aware of the types of accounts you have, what their after-tax amount is as you're thinking about how much you need, because there's a big difference, right? And the taxation really impacts it. It's a good time to fund Roth accounts. One strategy is, as I think about Roths, is if you have kids and they're asking what accounts they should fund, up to a certain amount of income, I almost always say fund the Roth. So typically till someone's 35 or 40, and if they start to then move into these really high income tax brackets, maybe then we switch to traditional. But young people should probably be funding Roths. So just if you're thinking about your kids and any advice you can give them. Early retirement, again, understand some of the impact on Social Security, Medicare, fill the brackets in your low income years. And then be very careful about how you use your required distributions, and work on the estate planning more from an income tax perspective. Have a solution for yourself. You've taken the time, you've taken an hour, you're probably at a point where something is triggering you to be here today. So, let's start creating a solution for yourself. Think about how all these impact you, and, start maybe making some changes along the way so that, you're incorporating some of these traps as part of your solution. One of the things that if you would like to take advantage of it as part of kind of my desire to educate, it's also trying to be a resource for people to understand how this works for you. So at the end of the session, if you would like to schedule a strategy session with us, half hour, just kind of talk about, ideally, we talk about these key areas. How are you prepared? How do you feel about your preparedness for retirement, really? I will help you kind of identify some key planning and tax issues that you should be thinking about, and come up with a few steps, some actionable steps to move forward. And what you will leave, our discussion with is just a little bit more confidence and knowledge for your retirement planning and kind of your best next steps. So we are moving into the time for questions. And I do have a few questions that have come in, so I'm going to go over those. So the first question Sue asked, is there a tax reason to delay Social Security? And feel free to keep, as we went through this, or if any of these questions trigger something for you, please keep typing away questions. It's good. Excuse me. So tax reason to delay Social Security. I would say yes for two reasons. The tax reason would be, remember we talked about those low income years. So let's say, I hear all the time, people want to retire at 63, 64, they're going to start their Social Security anyway. It might be a good not only do you get that extra 8% per year if you wait, but what it allows you to do is have those lower income years where you might be able to manage some of your other accounts to fill those low income buckets. So just think about, again, think about your overall situation and whether that would be an opportunity for you. And that would be a good reason to delay Social Security. It's also a time, where you can do the Roth conversions and things like that. So I would say it's good if you pre-retire to hold off Social Security for that reason. Even if you retire at full retirement age, maybe you wait to 70, maximize your Social Security, use those couple years again to manage those tax deferred accounts so that they're not so large in the future. So there is a tax reason to delay Social Security. Second question, let's see. Jack asked, does the Secure Act require Roth distributions over the next 10 years too? That's a great question. So the Secure Act, just to summarize, I think the Secure Act for you guys mainly changed two things. It changed your age of distribution from 70.5 to 72, just to remind you of that. And then it also changed this 10-year rule of these tax deferred accounts. So a Roth does have to be distributed over 10 years also. So that's something to be aware of. However, if you think about it, the Roth has no taxation, at least we hope. We hope that doesn't change. So it doesn't, so even though it has to be taken out over 10 years, that's not as big of a problem. The beauty of that one is, and some of this is, I always encourage people, start talking to your kids if you're older about these things, because they may not understand it either. Because if someone's going to inherit a Roth IRA, but they can now wait, so right now they would have to take that Roth IRA out starting when they inherit it. So they have to, every year take a little bit out. But now they actually get to wait 10 whole years. So they get to have that money grow for 10 whole years and then use it. So that's a really good part of the Secure Act. And especially if you have money in a Roth IRA, it allows that long-term growth even longer. So, but it does have to come out and be used. Is a Roth 401k, Rose asked, is a Roth 401k or IRA always a better option pre-retirement? This is a little bit what I was referring to with the young people and their income tax bracket. Sometimes, especially like pre-retirement, you might be in your highest income tax bracket. And if you're not going to be spending at the same level and your income is going to be a lot lower in retirement, right, what you need, then I would say a traditional account is likely a better account. Again, it's all about taxes now, taxes later. So I would not say a Roth is always your best option pre-retirement. Again, I would say for younger people, it most likely is, but maybe not for everybody on this call. So it's kind of, it depends is what I would say. Do state taxes, Linda asked, do state taxes affect your situation very much? Yes, for sure, they can. One thing I think a lot of people in Illinois are not aware of is what is not taxed during retirement in Illinois. Many of us complain, oh, our property taxes are so high. They are, but our tax rate at 5% is really not very high comparatively. And then what also you need to be aware of is pension income and all retirement income in like IRA distributions, things like that, are not taxed in Illinois. Not right now. That's not saying, Pritzker won't put through a new tax change, but a lot of income for retirees is not taxed right now. So, frankly, Illinois is not tremendously different from a state taxation than maybe a Florida is. So that's just something to be aware of. And I think a lot of retirees are very, very surprised by it. So, if you want to move out of Illinois, that's fine, but don't necessarily do it because of the taxes when you retire, because the tax rate's at that point lower than a lot of states, quite frankly. The other thing really to be aware of is that Illinois, most states match the federal government in estate taxes, like how much you get an exclusion for. So in most states, the estate tax, the gifting tax, is irrelevant. It doesn't matter. Illinois is one of the few states that doesn't match. So the Illinois exemption is, and I know for most people this isn't an issue, but it's like $4 million versus the federal, which is, 10 for a couple, I'm talking couple rates. So if you do have a fairly good net worth, be very careful where you're living, because certain states don't match the federal taxation, and you may get a surprise that you're really not aware of. Let's see. Jeff asked, can I continue to contribute to an IRA when I retire? Yes and no. You have to have earned income to contribute into retirement accounts. And earned income means something that you're working for. So, something you probably get a W-2 for, or, something that you put on your taxes as earned income. So if you only have like pension income or Social Security, something like that, you can't still add to any of these deferred accounts. Just so you know, that's there. I think I have time for maybe one more question. So here is a question. When do we stop filing taxes? Well, you only stop filing taxes when your income is low enough, with deductions and things like that, that you don't owe taxes. So I would say that, as long as you think you're going to owe taxes, then you need to keep filing. Even, with this whole economic recovery payment that came out of COVID, I think the people who had still filed taxes, they might have gotten their money quicker. But really, you stop filing when you don't have to pay taxes. Although sometimes it's recommended that you keep doing that. So if you work with a tax person, they'll give you that answer. So we're almost right at the hour, and I want to be very respectful of the time, the commitment that we made for an hour. Again, I hope that this was very helpful for you. I hope it gives you some knowledge in how to structure accounts, use accounts, distribute money. Beware of some traps that are out there for many people. And again, if I can be of any assistance, love to schedule a session with you to chat and answer any questions that you have, and be a resource for yourself. So I hope you have a wonderful day, and thank you for being here, and good luck in creating your solutions. Take care.